Good day and welcome to this episode of A Focus On with myself, Fifi Peters. We are coming to you today from the African Mining Indaba, the 33rd African Mining Indaba, which of course brings together industry stakeholders across the mining value chain to discuss the sector's most pertinent issues. The theme of this year's Indaba is future-proofing African mining today. And as a Pan-African lender, Absa will have a critical role to play in supporting its clients through the transformation from a sustainability and a technological framework. I spoke to several executives here at Absa about their assessment of the mining sector in Africa right now and their approach to future-proofing mining from a capital allocation point of view. Craig, once again, thanks so much for your time. It's amazing how quickly a year passes. We do this annually, obviously talking under different umbrellas and different themes. The theme of this year's Mining Indaba being future-proofing mining for today. And we were talking offhand about what that means, depending on which hat you are wearing. As a financier, maybe let's start there with your interpretation of what future-proofing Africa's mining sector does look like from a financial services point of view.
Thanks, Fifi. If we look at future-proofing, and I talk in the first instance from us as Absa Group,
sure,
and particularly in the mining space, is making sure that we use our capital, our balance sheet, our advisory capacity, our ability to go to capital markets on behalf of miners, to ensure that there are sufficient resources now and in the future for the transformation into an energy-efficient global world. More importantly, it must be done in a sustainable manner. We're very aware of that. And benefiting both communities, countries, governments, and importantly, and sometimes this is forgotten, shareholders. Because there's always that balance between the risk of a shareholder having to put into capital over the long term into mining, which takes time, has risks. You're never completely certain with regards to your output and what prices you'll get for it. But what we have to do as Absa Group is ensure that we screen all the opportunities, we examine them closely, and we make sure that in 20, 30 years' time when we look back, we've done the correct allocation of our capital to benefit as many stakeholders as possible. Mm-hmm.
So quite a number of elements there in the value chain to balance, and you're talking about the approach of Absa Group. But you have an interesting piece in which you make an interesting argument and you question whether that is the approach broadly at national level as well as at industry level. This approach to capital allocation that is future-proof, something that you just mentioned right now, that balances the short-term needs with also the long-term resilience of the industry. Can you just talk broadly then for us as to what future-proofing resource allocation does look like at a broad level and to what degree it is happening on the African continent right now?
It is happening. Where we look at is, in terms of our capital, we're a bank. You've also got the capital from shareholders. Now, shareholders can be at times quite short-term minded in terms of what are their returns, their dividends, if it's a listed entity, where's the share price going, etc. But at the same time, we've got to look and make sure that in terms of an extractive industry, remember mining, it doesn't regrow, it's not agriculture. So what is left behind after that? From environmental rehabilitation, communities, government, participation at times, and we sometimes see it a bit skewed that many governments and mining jurisdictions and their legislation framework focus very much on what the country can get in terms of tax revenues, etc. And capital is fungible. It'll go anywhere. So you then find that, particularly we see some of the instances in gold in West Africa, where with changes to the tax rates, the free carry that is given to government, etc., many of the mining houses are wanting to exit because it doesn't make sense for them to keep committing capital that gets trapped, that gets taken, and they can't provide that return. So that is the balance. Shareholders and the greater equity market needs to get a certain level of return, otherwise they go global. And at the same time, the countries need to ensure that that resource is a once-off, that they can actually benefit from it, replenish, and build for the future when that resource is exhausted.
I know which particular countries and examples you are citing, and perhaps a good point to present also the other side of the argument from these governments who are saying that a lot of these mining companies are also not paying their dues when it comes to the correct level of taxes and royalties. But we'll park that there for now. I suppose just to look specifically at your portfolio in terms of origination and the kind of deal activity that you're seeing. Here, we have been speaking about critical minerals, and it's been the talking point for several years, the copper, the lithium, the nickel, and all of that. What are you seeing in terms of investor appetite right now, based on the kind of clients, I suppose, who are knocking on your door?
Fifi, in terms of future metals, copper is the hot commodity. Everyone is asking about that. You've seen some of the activity in Zambia. You've seen the activity in DRC, notwithstanding some of the issues that are currently there. And I'm talking from an Africa perspective.
Sure.
You've also seen globally some of the mega mergers, which are focused on copper. You saw the BHP bid last year for Anglo, which is predominantly to build up BHP's copper portfolio. We read recently in the Financial Times that Glencore and Rio Tinto had also started to speak. So everyone is after copper. You've also seen the Middle East come through quite strongly in terms of acquiring copper as a strategic resource. Copper is one of the few commodities outside of gold that over the last 2 years has retained its commodity price and actually increased. Virtually all other commodity prices have dropped off in the last 18 months. Whether it's lithium, nickel, cobalt, they've all come off. Iron ore, coal, they've all come off quite substantially. So it's gold, which, because of the uncertainties in the world, particularly post the US election, etc., it's almost at an all-time high, I think, of $2,860 an ounce. But gold is a safe haven. It's a peculiar commodity. But in terms of commodity, everyone at the Indaba, everyone we talk to, is wanting copper opportunities. If you go down for a tier from that, lithium remains very important. The lithium price has come off massively. And the implication of that is that certain lithium deposits and resources may no longer be viable to actually mine at that price. So at the moment there's an oversupply of lithium, but 2 years down the line, will production have increased to match that demand? So we do think in a year or two that lithium will be back in demand. So people are looking at lithium, a bit on nickel, but it is predominantly copper. And then, of course, there's the rare earths story. And everyone talks about rare earths.
Particularly right now.
Look, it's a fabulous name.
Yeah.
Particularly as, if you look at it, they're not that rare. And rare earths, it's about, if you go back to high school chemistry, it's about 17 elements on that table of elements, which we all hated. And they're all over the globe in the Earth's crust. But many of them are not in the required concentration to be economically viable, or they're mixed with other commodities that you've got to separate. So we've got quite a few rare earths. Africa's got a lot of rare earths, but are they economically viable to mine? Then importantly, you have to process them, because rare earths are used in everything from battery technology, solar panels, your cell phone, semiconductors, superconductors, across the board. The challenge everyone's got is 60% of rare earth production is out of China, and they process about 90% of the world's production in rare earths. So there's a big move from all the globe in terms of ensuring you have that strategic resource secured. So rare earths is the next, if I can say, battleground. And this is outside of politics. It's merely trade flows and who actually has the process and who sets the price. So what we do see across Africa is a move to rare earths. There's a range of them with the most amazing names. I think, neodymium and terbium are the two most important, because they form this, you create the strong magnets. And as you know, in electric motors, Teslas, wind farms, etc., that is the most important aspect. So if we had to see where there's going to be a focus on capital allocation, rare earths is one. The US and many other countries are putting in incentives or frameworks to ensure that there are rare earth developments in country, or they secure supply to those rare earths, so they're not kind of held to ransom in a sense. In South Africa, we need to get to that point. We have our strategic mineral plan, and it's mainly focused on manganese, which we have 85% of the world's manganese, I think. So it's just a balance here, and everyone across the globe, from industry to government, is very wary of who's controlling the strategic flows of that metal, the processing, and who's setting the price.
So 2 last questions I have for you. I mean, you talk about these minerals outside of the politics, and I wonder if we can really leave the politics at the door right now, just given the heightened geopolitical environment that we're in right now. And I suppose not to drill down to details, but just to speak broadly in terms of how you do see some of the shifting trade dynamics and the shifting geopolitics affecting any exploration or any drilling, any M&A, as it were, in the mining complex? Or do you see the industry sort of looking through the cycle because of the overall target that is being reached or that is being aspired to right now in terms of the just energy transition?
I think with all these the trade wars, as everyone calls it, people looking at strategic minerals, putting in place these frameworks, I actually think it's going to be beneficial for mining. It's going to force development. It's going to force alternatives out there. I think capital will flow globally, provided people can get that security of offtake. And what we see is all the mining producers, the sovereign wealth funds, government funds, they will put capital to work in a particular country. They will take a portion of the ownership. They will help fund the mine, the logistics support, etc. But what they do want is to secure an element of that offtake.
Sure.
Whether they use it, they have it. So whenever they need it, they can call upon it. So I think with all of these, the geopolitics, the Trump trade, etc., it will be very beneficial to mining development and mining production. And in a sense, I think the prices of certain commodities.
So let's talk about mining development as a exit for this conversation. Going back to some of the examples that you mentioned the deal activity that we saw in the copper space between the BHP and AngloBid. We're still watching to see exactly how that ended, whether the story is over. You mentioned Glencore and Rio Tinto, but what you're talking about is M&A here, and what has been lacking in the industry, according to a lot of experts, is greenfield investments in the sector. And I'm just wondering whether you are seeing, with the pricing environment, with any political environment or regulatory frameworks, any appetite to actually put fresh money in the development and exploration of new mines as opposed to just M&A?
Viv, it's an important aspect you raise, because with all these mega mergers and even all the consolidation of certain producers and everyone, they are buying operating assets or near to operating assets plus a few of the reserves. What is happening is that those resources are being held in fewer hands. What we don't necessarily see all the time is these greenfields investments. There are a couple of companies that are starting to do it. The one in the spotlight is Cobalt,
Sure.
which, as you know, was initially founded by Bezos and the Microsoft founder. And they've got an AI technology trying to go around in terms of like geo mapping to ensure that your success rate in terms of a drilling program into actually developed mine is at its optimal. So we're starting to see that, but it is a slow process in terms of greenfield developments. It's legislative certainty, it's sometimes the logistics that you've actually got to get your product through to the rail, the port, and importantly in some of the copper districts like Zambia and DRC, etc., there's a huge issue with power. So even if you develop a new mine, you don't have the certainty in terms of your mining production and smelters, etc., of a constant and sustainable power supply.
I was talking to the World Bank, and of course you would be aware that they're on a drive to power 300 million people on the African continent with partners by 2030, this Mission 300 initiative. We shall wait and watch and see if it is actually successful. But Craig, nonetheless, thanks so much for your time. Great conversation as always.
Thanks, Fifi.
And Tana, what I like about the African Mining Indaba is that it's essentially the official start of the calendar for the mining sector. And so if we reflect on that and what that start does look like, just coming from 2024, where we So volatile commodity prices still, but I suppose that's the name of the game. But we saw that volatility work for some minerals like gold and not so much for others like PGMs. Your assessment of the mining sector right now as the year unfolds is what, sir?
So, I mean, I think this year is going to be another mixed set of results from a commodity perspective. I think you started off by saying gold was favorable last year. I mean, what is it? I think a 30% increase. Our assessment for this 2025, we do expect it still to be volatile. I think, there are enough geopolitics at play at the moment. I'm expecting, gold to be range bound. It's not going to shoot the lights out like last year, but it's still going to be. I want to be in gold. If I was an investor or whatever, I want to be in gold at the moment. There is certainty and predictability around it. PGMs, I think, is going to be another challenging year. I think we did see prices come off last year. But I think at times we forget from where they were coming off. I think 2022 was quite a bull run for the PGM market. But I think what I like about PGM is the fundamentals. They're all pointing to, at least stability, and then maybe we can start seeing it creep back up. Last year was, it was a bloodbath, right?
Sure.
10,000 jobs on the line.
Yeah.
CapEx has come down. But this year you look at it, we're seeing the West or more the US leaning towards back to your drill phenomena. Yeah.
Which means what? I know you're touching on the resource element of your portfolio right now.
Yeah.
So the drill, baby, drill pronouncement by US President Donald Trump. Yeah. We know his position on fossil fuels. We know his stance on climate change. And we've seen what he has done regarding the withdrawal for the second time of the Paris Agreement. That means what exactly in your view?
So, effectively what that is going to do is going to lead to a demand in your PGM metals.
All right.
For your motor vehicles and all that.
Right.
But that's the outlook we're beginning to see going forward. I think what's also important as well is I think the transition to battery electric vehicles. I think there's acceptance now that it's going to be a lot slower than we thought it was going to be. I think it is costly, and even just from an infrastructure setup, it does take time. Yeah.
So if we stick to the point on the transition, as financial institutions, you yourselves have also taken certain pronouncements when it does come to climate financing and also financing of sort of traditional energy areas like fossil fuels. As you did mention, it may take some of your clients a little bit longer to go ahead or push forward to net zero.
Yeah.
As a financier, what does that mean to how you are approaching investments in both spaces right now?
So I think we have to be responsible, right? But I think at the same time we need to be flexible within the environment that we're in. We should never forget that we play on the African continent. We are blessed with certain things more than others. So you can never turn a blind eye to one thing because at the end of the day, we do need to, I think we're part of an ecosystem around jobs and, we need to play our part within that. Yes, it looks like people are deferring out their target timelines, but I think as long as timelines still exist, I think then, we're all working together.
Sure.
Yeah.
So we touched on investments and you are seeing still the possibility of upside for gold, although you did say that it's possibly range bound after rising by 30% in 2024. You're seeing perhaps more upside for PGM basket.
More flat. Like I don't expect PGM to go much lower than this.
Okay,
I think we're at the bottom of the PGM cycle.
They've hit the bottom, right? What then does that mean for the kind of trends that you are seeing in terms of mining companies making investments in the space, either exploration kind of activities, either M&A. If you can just speak to us based on conversations that you're having with your clients about how they are likely to respond to this pricing environment.
So, I mean, I think we have to split it up, right? So your gold guys naturally are the guys wanting to do M&A.
Sure.
They're the guys spending on capex at the moment. They're the guys looking for assets exploration. And I think some of them are coming under pressure in terms of, they're sitting with quite large chunks of cash or generating cash, but there aren't assets which fit their portfolio at the moment. So I think that's a challenge that some of them are facing. In the PGM space, I think it's still about survival, right? I mean, they've all come out and said we're cutting costs, managing costs. So, we're not seeing much new capex spend, and I don't expect to see any capex spend in this year into next year. It's about survival. But just like with gold, so too shall PGM turn. I mean, there was a time, if I think back, where gold around 2018, if my memory serves me correct, they weren't spending.
Sure.
It was about survival, and PGM was still spending. So I think it's just the cyclical nature of it, just swapping it out into different asset class.
You make a really interesting comment about gold and the kind of assets that clients are seeing out there, and the fact that they're not ticking boxes in terms of putting new capex in the ground. And I just want to understand maybe what the setbacks in the box ticking potentially could be. I mean, here already we have heard so much about the enabling environment, and there has been aspersions by a few mining companies that perhaps it's becoming a little bit difficult for mining in Africa because of things like higher regulation, because of this renewed calls for beneficiation, because of even taxes going up in certain jurisdictions that are not so favorable for the business environment. So maybe you can talk to us about your assessment of the regulatory and the business landscape here in Africa, and to which degree it is becoming a lot more favorable, and to which degree it's becoming more difficult to operate based on your clients.
So there are challenging areas. I mean, let's not candy coat it where, I mean, if it was my money, I also wouldn't put it there, right? So I think what we've seen is, if I talk about West Africa, also a shift in thinking. There was a time everybody wanted to be in West Africa, right? But I think, there've been certain things which have happened, which are making it less attractive, right? But I mean, there's still countries which I think are still very investment friendly within West Africa. I think countries like Ghana have continued to be predictable regulatory environment, which favors people to want to go into those regions. You look at Southern Africa, I think by and large, also been a favorable environment. But I think Southern Africa has its own challenges in terms of, you look at South Africa, our mines are deep. They're no longer as attractive as they were 50 years ago, right?
Which perhaps ties into the theme of the 2025 Africa Mining Indaba, talking about future-proofing mining today. And I know that it's a theme that leans quite heavily on technology and innovation, although there are other areas such as inclusivity when it comes to youth and inclusivity when it comes to women that speaks about future-proofing mining. So when you make a reference about, South Africa, the mines are a lot deeper, it's a lot difficult to get there, and perhaps also not as safe right now. What is your assessment of the theme future-proofing mining, and ultimately the role of financial institutions in helping the mining sector become resilient for tomorrow?
So it's about sustainability at the end of the day. And for me, sustainability, I always use this example, is, are we leaving a place better than when we got there? And I think for any mines, I think anywhere on the continent, if they come there and leave it better than it was before they got there, then I think they've executed in their obligations. And that's quite broad in terms of, education, gender equality, job opportunities, leaving an economy, in place which survives post the mine shutting down. That for me is future-proofing mining going forward.
And that wraps up this week's episode of A Focus On. Thanks so much for watching as always. Have a great day further, and remember, stay watching CNBC Africa.